current quarter or the year. And that has I think the net effect of helping clients secure financial and retirement security over a long time, stay invested for the long term. I think that's been a net benefit to the industry to shift to that language rather than beating benchmarks. Second thing is I think it makes relationships more holistic. It makes them more long term. It makes them less fleeting. It makes them less about markets and more about plans. The second is personalization and personalized portfolios at scale. It doesn't matter whether you're going to a small firm, a big firm, a global firm, a US player. Everyone is talking about how to make portfolios more personalized. And I think that's attached to the first, to planning, right? Which is portfolios should match plans. But when we talk about personalization, it's a word we hear all the time. You and I will hit on personalization more in this session. What do I really mean by personalized? Personalized means something that is co-curated with clients, meaning that the client participates in the actual shaping and choices made in the portfolio in a collaborative way, not in a way where I hand you a portfolio as an advisor. The second is that the portfolio solves something that is distinctly the client's problem or desire. That might be taxes, it might be values, it might be risk, but it solves that client's particular problem. And the last thing is that it uses technology to be manufactured at scale. So co-curated, right, solves a client's particular problem and can be manufactured at scale. And then that last thing is digital. Everything has to be digitized, right? The expectations are high, but it's everything from billing, client statements, client order management, portfolio management, risk reporting, trading. Everything really needs to start with a tech first, and I'd argue mobile first mindset when it comes to clients. But those three things, they are powering everything. I sit in this, I have the best job at BlackRock, in my opinion. I get to work with wealth management firms in this $36 trillion TAM here in the United States. It's an epic market. It's extraordinarily fun. But I will tell you, it doesn't matter if you're big, medium, and small. It doesn't matter if you're catering to the emerging mass affluent, the mass affluent, high net worth, ultra high net worth. Everyone is thinking through their strategy on those axes, financial planning, personalized portfolios at scale, and digital.
So I find those trends so interesting. And as you think about sort of how the market will evolve over the next 5 years, who do you see to be the winners in the space? Clearly, the folks that do this right. But can you go a little bit more into that?
Yeah, so a couple of thoughts there. My grandfather was a stockbroker. He was a stockbroker at Shearson Lehman. And I use the word stockbroker intentionally. That was his job, was to broker stocks for a commission. And he was the character of a stockbroker here in New York. He drank 2 or 3 martinis, at lunch, and was proud to do so. He smoked a pack of Marlboro Red cigarettes. He lived to be 101, so let that be a lesson to you about kind of how life works. But this industry would kind of be unrecognizable to him, right? His job was largely to match client orders and to sort of bring Main Street and Wall Street together. The idea of a holistic relationship, of being a financial planner, being a life coach, of helping clients develop long-term savings plans, of helping them think through how to buy a boat or vacation or college savings, that was not his job. That was not at the core of his expertise. And today, I think what's really been remarkable, and you see it in all the winning wealth managers, is shifting to this holistic quarterbacks to US, right? It's got to be like, center midfielder, right? Like centrocampista person who's at the middle of a relationship and can help bring together taxes, retirement planning, college, intergenerational wealth transfer and trust and estates, onshore, offshore in the cases of your markets. Those are really the winning business models. I'd argue things that used to matter a lot. Things that used to matter a lot were the portfolio. It used to matter, like I pick these managers or I pick these stocks. A lot of that has really been standardized, I think, in the US market, and that's been through the advent of model portfolios. Model portfolios have created tons of scale where they allow advisors to manage with personalization many thousands of portfolios for clients and focus on the things that I think are the differentiator with a client, right? Which is planning, which is dream management, intergenerational wealth transfer, taxes, values, all those things that that only humans can do today. And those are the things I think are the winning models. There's an analogy I have for this, which is I think of the sort of streaming market today, right? The streaming players, Hulu, Netflix, Amazon Prime, Peacock, all of these subscription-based services. all of them used to be in the business of actually building out enormous tech stacks, right? And servers where they would have to store enormous amounts of content. And they would be in the logistics business of sending people DVDs and getting DVDs back. The advent of the cloud computing market basically just made everybody a scaled player instantaneously. And I argue that's what's happening in wealth tech is through the ability to manufacture portfolios at scale, the ability to use technology as a way of customizing thousands and thousands and thousands of portfolios, right? It makes people focus on content. It makes them focus on the show, right? The program, the mini series, and the content associated with it, rather than how it's delivered over the internet or whether it's delivered in a DVD. And the winning wealth managers of the future, they're going to be able to really, really focus on their value proposition. One other thing I think is worth calling out on that is I think the winning wealth managers of the future are going to be ruthlessly clear about what segments they're doing business in, right? And what I mean by that is if I think about markets like ultra high net worth, mass affluent, emerging mass affluent, new to investing, new segments of clients, the most successful wealth managers will have a strategy that is tailored to each one. I think many firms will also pick where they want to compete and where they want to excel. I do think serving ultra high net worth households with excellence is very different than serving the emerging mass affluent. My experience, however, is that most firms really want to have a full life cycle, right? They want to be able to attract new investors and do client and customer acquisition through a digital platform, but ultimately be able to run a family office for a client. And then what becomes really important, and I think that'll be the purview of only a handful of players, but what becomes important is the client journey management. And that's where I think today a lot of firms are struggling to define how they migrate somebody from being a new investor who uses a digital offering to ultimately taking on an advisor, to ultimately maybe using private banking services and the liability side of the balance sheet. But I really think the winning business models will figure out those segments, the use of tech for scale, and that client journey management.
You made some really good points there, and I want to come back to the model portfolios in a second and sort of the emerging segments. But I think that last point is incredibly relevant in our space in Latin America as well, which is how do you differentiate your value offering to different segments of the population, and how do you make your private banking client feel that they're getting something different and unique versus what you have on your mass affluent or your emerging affluent space. So I totally agree with you. That will be a big challenge.
Yeah. That is the essence of personalization, right? Is making that client feel like something you can manufacture at scale is manufactured uniquely for him or her.
Totally agree. Can we talk a little bit about the new client segments that are emerging and how clients want to be served in today's world? Your third big trend was about digitalization. Mm-hmm. If we think about Latin America and in a way how COVID accelerated the need for digitalization in financial services, it's truly impressive. The amount of money that's going into the fintech space today, the amount of digital banks that are popping up, wealth tech players that are popping up, and then traditional wealth managers that are really entering the space is changing the landscape. And in our view, really opening up the wealth management space to segments that didn't have access to it before. Would be curious about your views around that in the States and more globally as well.
Sure. I think COVID has accelerated things that were already happening in the marketplace. So it's not as if digital investing is really new. It's not as if having a great online experience is new. We've been at this for the better part of 20 years. And I'd flag sort of two things, one of which I think is a tremendous opportunity, and one of which I would offer is a bit of a mirage, right? On the opportunity, it's that there are millions and millions of new investors being made every year. And as you know, in the last year, I think something on order of 40 million new investors have opened accounts that are basically digital first, great user experience, easy to use, get invested, start participating in the market at very, very low minimums, or even in many cases here in the United States at zero minimums, right? There are more free and complimentary offerings to help people get started, but they're all remarkably good client acquisition tools to bring new investors, whether they're millennial, Gen Z, whether they're from traditionally underserved backgrounds, whatever it might be. There are a whole new demographic of new investors being minted. And I think it's a remarkable opportunity for wealth managers to serve those clients with excellence in a way that they expect to be served. And what I mean by that is I do think whether it is a new investor or whether it is somebody who's very seasoned, COVID has accelerated this idea that everything should be omni-channel. I should be able to do business anytime I want. I should be able to sit in my pajamas in the middle of the night and log into my account and have a great experience where I can consume research, advice, generate trade ideas, manage my own money, leave a note for my advisor. But I should also be able to raise somebody on a screen pretty seamlessly for a conversation with a certified financial planner over a trickier topic. And I think if you look at where most of the full service, as well as what I'd say are full service light firms, particularly in the United States, are articulating their value proposition, it's in that flexibility, right? It's in that flexibility. And that's what clients want. They want choice. They want options. They want to be able to do business in their pajamas on screen, or in a branch on 53rd Street here in New York, or in Sao Paulo, wherever it might be. And I think those things, that idea of building flexibility into these client service models so that they're omni-channel, they're critical. It's what we're doing here at BlackRock too. I think we have some wealth management platforms where they want to talk to somebody who works at BlackRock about the markets every day. And there's other people who say, that's great. I really love iShares ETFs. I'm totally up to speed on what they are. Just make sure I get the latest content. We have to be able to serve clients in the segments in the ways they want to be served. And I think that sort of omni-channel mindset with digital as the backbone, that's the winning model for how I think sort of digital wealth wins.
I think you made a few points there that really resonate with us across Latin America as well. I look at the region today, and today an investor in one of our markets can access the stock market with extremely low commissions, $2 to $3 trades that used to be $50, right? So just the way that that's broadening access and the way that it's growing as well, to your point, as we saw the move towards zero commissions here in the state is interesting. And it's interesting how that self-directed market has really become the entry and the gateway for so many of those new investors. And to your point, it's a beautiful opportunity for wealth managers to think about sort of that multi-segment approach in their strategy as well.
I think one of the headlines that gets lost sometime is, particularly here in the US market, I also see it in Germany, I see it in other parts of Europe, is when we talk about self-directed investors, it's usually actually falls into two segments, one of which is truly self-directed, active traders who are buying and selling stocks. And we've had quite a bit of euphoria on that here in the United States over the last year. But more actually, it's consumers of managed accounts, which are managed models that have a great digital front. It's not robo. I want to be clear. It's not robo. It's actually a managed account offering where you can have one or two touch points a year on screen with a certified financial planner. And that hybrid advice model, that is really emerging as a fast grower all around the world, not just here in the US.
And so you talk about there the interesting shift in the role of the advisor, right? And how it's really changed from what it was 10 years ago. To your point, the advisor plays a critical role in the wealth planning process for folks today. What do you see sort of the advisors that are being most successful in their practices doing? How are they trying to leverage that financial planning? How are they trying to tap into personalization, customization? Would be great to hear your perspectives for the advisor.
Yeah. So one thing I wanted to inject here, which is just, I think it's important context for why the advisory model of the future is changing, is largely just the growth of fee-based wealth management all around the world. And so I think, in the US, if you were to roll the clock back 7-8 years, about a third of our market was fee-based, meaning 2/3 of the market, advice was paid for through commissions and retrocessions and things like that. Fast forward to today, more than half the US market is fee-based now. And in that transition from brokerage to fee-based, from transaction-based revenue to advice-based revenues that are long duration, durable, annuitized, markets-based, the advisor's value proposition inherently changes, right? It changes from picking managers or picking stocks to planning and composition of the whole portfolio. And so when we think about kind of what winning advisors are doing, they're leaning into those pieces, which are goals-based in planning. They're leaning into personalization, and they're relying on scale enablers, right? They're relying on things that create scale in their practice. So model portfolios would be the number one scale enabler, right? So when we polled advisors 5 or 7 years ago here in the US market, and we asked them, what's your biggest problem? They say, I have a crisis of capacity. I'm trying to manage my clients' portfolios to generate different trades. I've got to go out and do 400 orders every time there's a new rebalancing. And just they were spending, call it 2/3 of their time on operations and less time with clients, not just clients that they had, but also attracting and winning new business. Fast forward today, the migration to fee-based, the adoption of model portfolios has allowed them to go off and spend more time with clients and use more infrastructure like models and technology to put scale in the practice. So the winning advisor is the one that uses scale enablers, right? That taps into those home office resources, taps into technology, taps into asset management partners like BlackRock, who can give them specialization, who can give them markets, who can really help them grow their practice. And as I said, I think it's more about being a tremendous life coach, and leaning into the resources that today they're like cloud computing, right? It's like that Netflix and Amazon Web Services analogy I offered before, right? Focus on the content, less on, the data storage. And I think those advisors are going to win.
And I think that's so interesting. The topic of fee-based and how it's come, where it's come in the United States over the past 5 to 7 years. If we think about the region, and you and I talk about this often, we're still that 5 or 7 years behind, right? So we're still about 20% of the wealth management practice in LATAM is in fee-based. Mm-hmm. What we are seeing, though, is interesting is with the entrance of new segments, with the entrance of the affluent segment, the mass affluent segment, and then the need for scalable investment solutions, the model that makes sense is that fee-based model. And so we're seeing how wealth managers look to shift and really leverage and utilize technology. Yeah. Certainly, I think that technology, and you touched upon it a little bit, has been a key part of what's worked here in the United States. Would just be curious if you could talk a little bit more about the role technology has played in the role of the growth of model portfolios and really that scalable investment practice for us at BlackRock as well.
So let me talk about it, but I think one thing you're raising there, which is it's why model portfolios and scale are required, is fee-based is going to be the preeminent and dominant model for wealth management around the world. There is a long horizon still before that happens, but it's going to be. And I'll give you 2 reasons. It's because it's a win-win model, right? Which is clients like the flexibility, clients like the transparency, and then advisors like the long duration nature of the revenue. And I will tell you, if you look at the US model and you look in the UK and you look in continental Europe and in Canada and in Australia, you're seeing, fee-based wealth management take hold. The other reason is that for most bank affiliated type wealth managers, actually, it's the strategy of the global financial, right? The strategy of the global financial is to reduce the footprint of the business in things that are capital intensive and have episodic revenues, sales and trading, right? It's very capital intensive and has episodic revenues, and to move their resources and investment into things that are capital light, like wealth management, and have long duration of revenue, like fee-based, right? Long duration, more stable-based revenue. So the strategy, right, for shareholders, the strategy. So if you look here, the major big brand US wealth managers, that was their strategy post the financial crisis. Reduce footprint in sales and trading, move more footprint to things that are long duration and capital light. That's the strategy of asset managers, is to be more capital light. So the trends over all this time are powering fee-based wealth management from the client side, from the shareholder value side, and from the regulatory side. So this is here to stay. I can tell you, I think the world will one day, I probably will be retired, I hope, but the world will one day be 100% fee-based. I can't give you the horizon for that, but I'm telling you, those are all of the forces. And so it's because it's the client's interest, the advisor's interest, the shareholder value interest. And that's the reason that when you move to fee-based advice, everything becomes about that whole portfolio conversation. Everything becomes about personalization, and everything becomes about how to manufacture those portfolios at scale. And so let's talk about models for a second in that context. But they have to be, the reason models are going to get bigger is because fee-based wealth management is going to get bigger. And models themselves have proved to be enormous scale enablers for practices. So one thing I'd call out, one of the things that we see in data very, very clearly and very consistently is that advisors who have adopted a models-based practice experience higher growth rates than those who haven't. The reason for that is they spend more time with clients. They spend more time winning assets away, and they spend more time attracting new clients. They're also able to have a scalable, repeatable, definable, customizable process that sits in technology, and you can substitute out one ticker if a client wants something different. And so that growth of models, customization, it's really being fueled by these technology backbones. Last thing on that is I'd say there's two archetypes in models, right? There's maybe three, but one is home office models, right? So for many of the large global financials with wealth management businesses, they're already building these huge centralized CIO investment offices. That's historically been the European private banking model. Here in the United States, you really see that across the traditional national wirehouses. But now you're also starting to see it across the independent wealth managers who are using technology firms as a way of creating centralization and creating model portfolios. And the customization is relatively infinite because it can be automated. And so I'd say that's the spot to pay attention to. And in Latin America, I think when I look across different countries in the market, that's the thing that hasn't quite taken hold yet, is sort of definition of where we're using home office models. Some folks on this call video definitely have that strategy. And where can we tap into tech, either third-party tech or our own tech in order to deliver models at scale. And I think those are that's the trends in the US. I think they'll most definitely be the trends across Latin America as well.
And I think that last point you made around technology to scale models, I think that's the next step for us, as you mentioned, in the region. How do we have that technology that will allow the advisor to rebalance thousands or hundreds of accounts with one single click? To us, that's the game changer. Martin, but I can't let you go without talking a little bit more about personalization, because you mentioned it up front. It's such a relevant theme in how portfolios in the wealth market are changing today. Would be curious your views on personalization, the shapes and the forms that it's taking today, and then what are we doing at BlackRock around it, where I know that you're leading some really interesting efforts there.
Sure. So again, come back to the definition of personalization, right? Which is it's co-curated with a client. It solves a client's distinct problem or investment objective, and it can be manufactured at scale, right? That's our definition of personalized portfolios at scale. So a couple of things is, I think the winning portfolio of the future, right, is one that goes beyond the public markets and it moves from the traditional stocks and bonds 60-40 to something that's more like 50-30-20, right? So it's 50% equities, 30% bonds, and 20% private markets. And that has not taken hold yet. But if you look at the liability hurdles that people have, the growth targets that they have, they're going to have to start blending public and private together in order to really have portfolios that meet long-term client objectives. So the winning portfolio of the future will start with moving from just all public markets to one that is public-private. The second is that it will integrate clients' individual objectives more. So in the US, tax is a huge part of that, right? The client that lives in the state of New Jersey has a very, very different tax profile than the one that lives in Texas or Utah. If you look at most of the way portfolios are manufactured today, we don't really draw huge distinctions across our client base, but that has to be the starting place. So traditionally, we built portfolios first through the lens of risk and return. We need to actually flip that. We need to start with the client's individual tax circumstance and after-tax portfolio construction. I actually think this is pretty global. After-tax portfolio construction for taxable investors needs to be a Nobel laureate winning field. It's not today, right? There's a lot of Nobel Prizes given out for Markowitz and sharp returns and risk and efficient frontiers, but all those things assumed away taxes. And taxes ultimately are going to be the things that consume most of what our clients use to pay for groceries, right? Our clients don't pay for groceries with unrealized, gains and losses. It's with the after-tax dollar. So that tax piece is important. The other thing that I think is enormous, though, is ESG and values-based investing. And one of the things that I think is missed here is that this is a remarkable way for advisors and wealth managers to talk to clients in a language that they understand. So I would offer that clients, it doesn't feel very personal to them when you talk about large cap value or large cap growth, or this manager's in the top decile, or this one uses a global systematic approach in order to select security. Those things don't really resonate with clients. The things that clients inherently understand are supply chain risks, litigation risks, environmental footprint of companies that treat their employees well, companies that are navigating ecological litigation, regulatory. The clients get that, right? They understand it. It's a language that can fuel their investments. So I think there's something here at the intersection of ESG, sustainability, and values-based investing, but also for clients to just better connect with their advisors on how portfolios work. And so that ability to deliver ESG customization in a portfolio, it's not just a way of creating outcomes across risk and return. It's a way of creating better client conversations that keep clients and advisors more connected And I would argue to you, keep clients more connected with their portfolios and invested for the long term. And then the last thing I would say just around this is private markets. And traditionally, I would say all wealth managers around the world overvalue daily liquidity. They overvalue daily liquidity. They want instant access to money.
Could not agree more.
Right? And the reality is they don't withdraw that much, right? And so there's research at BlackRock that we've done at the BlackRock Investment Institute suggesting at a high level, if you had a 5% annual withdrawal rate, a 20-year horizon, and say a 7% return target, you could have up to 20% of your portfolio in non-daily liquidity investments. And so I think there's remarkable opportunity to both diversify portfolio into private markets, but also improve kind of income and risk return profiles using private markets and being able to integrate those things into models. That's where we're spending a lot of time here at BlackRock and having sort of hybrid public-private, both products, but also model portfolios. And I think those things will fuel, the portfolio of the future. It's 50-30-20, it's personalized, it's tax smart, and it's digitally engaged.
And I think to your point, those are some really interesting points. But when you talk about the importance and the global relevance of tax, that's certainly something that's every day more and more relevant across Latin America. And it's even more relevant when we see the flow of money between the onshore and offshore markets, right? So coming from the region to the US and back. And I think that what really that has done for us in the region, it's really opened up the spectrum of investment opportunities, right? So the ability to tap into private markets across the US and Europe is certainly something that is a changing proposition for end investors across the region today.
Yeah. The other thing I'd say, just that I think all of us are going to have to contend with, is that historically, and particularly in Latin America, the way to access sort of global, global stock markets and global bond markets, right, investing, right, you could buy the S&P 500, for example, in the United States, and you would have implicit global diversification because those companies had global business models. But I think we really have to mark this period in history right now as the beginning of some of the deglobalization or sort of uncoupling of global markets. And I think if you're trying to build diversified global portfolios, wealth managers are going to have to be more deliberate about where they get their US exposure, their European exposure, their emerging, their developed market exposure, because it's not going to be through long one market. And all markets aren't going to be as inherently global as they used to be. And so I think this portfolio of the future is also a way thinking through thematic investing. The sector-based investing is not going to capture thematics for digital markets, for example. So I think there's great opportunities to connect clients with these trends, but also improve portfolios. But you got to be purposeful about it. You can't just be long, broad US markets or broad European markets and capture all that global diversification anymore. And this is, again, where I think working with firms like BlackRock can be of huge benefit to our clients. Leverage us for that stuff. We can be a tremendous scale enabler. We can be your cloud computing for those things. So I hope everybody gives that a shot here on this call.
Certainly. Well, look, I think it's an exciting time to be in wealth management. As you said, for us, it's a privilege to work with so many of our clients out there as we navigate these changing times. It's changing from a business model perspective. It's changing from what our end investors want, who the end investors are, and then, as we talked about at the end, throughout portfolios. So, Martin, thank you for being with us today. I know we're looking forward to having you visit us throughout Latin America, hopefully pretty soon later this year. But it's been a pleasure. Thank you so much for joining us.
Thanks to you, and thanks to everybody for joining. We appreciate, again, all the partnership with BlackRock, and I am looking forward to getting on that plane and seeing everybody.
We will be there soon. Well, before handing back to Nicholas, again, as Martin said, just wanted to say thank you to all of you for joining us for the partnership with BlackRock. And we really look forward to all the conversations that we will have. Before handing it back to Nicholas in Mexico City, we'll pause for a short video. Thank you all again for joining us for this conversation.
When companies fall short of including diverse voices, they miss out on opportunities that advance innovation and, in the long run, economic success.
Through our fiduciary lens, we closely review how companies are promoting a diverse, equitable, and inclusive workplace. This is why we support initiatives such as Pride Connection, It Gets Better, and the Human Rights Campaign. We also support women in finance and the 30% Club.
Having greater diversity of leadership in Latin America can enable companies to develop their businesses so that they more closely reflect and resonate with the customers and communities they serve.
We recognize that building a strong and diverse workplace can take time, but when companies do, they are better positioned to create long-term success and, of course, respond to the needs of their stakeholders.
Thank you very much, Federico and Martin, two real rock stars. That was incredible. Great way to start off our third day here at the event. Now, as we prepare for our next session, I just wanted to remind you that you can find more great content from BlackRock on their YouTube and their social media channels. So do please follow, like, and subscribe for more information. I would also like to reiterate that the highlights and features from all 3 days of this event will soon be on BlackRock's YouTube channels and on Bloomberg Linea's YouTube channels. We will have extended versions of all the content from day 1 and day 2, and also some choice highlights that will be very easy to consume across different platforms. We are filtering all through that excellent content in order to provide those sort of bite-sized insights for the audience. Now, yesterday we mentioned some of BlackRock's podcasts. El Encuentro, their podcast in Mexico, and The Bid, their global podcast. Now, personally, I'm a big fan of podcasts. I'm a big fan of both, so I do recommend tuning in. You can find those on Spotify and other platforms. I also recommend that everyone tuning in check out Bloomberg Linea's daily podcast. La Estrategia del Día, which is available in Mexico, Argentina, and Colombia, is just a fantastic production, and I'm sure everyone tuning in today would enjoy listening to it. Now, next up, we have a very exciting session. Indeed, it is one of the sessions that I've been most looking forward to over the 3 days. We are going to be joined by Michio Kaku, theoretical physicist, best-selling author, and popularizer of science, and Lance Braunstein, head of Aladdin product at BlackRock. Now, they are going to be discussing technological disruptions and the endless opportunities that they provide across Latin America. Now, some of our audience in Latin America may not be too familiar with Michio and his work. So let me take some time to tell you a bit more about him. Now, be prepared. This is a long CV, but it's very interesting, and I think it gives good context to the conversation we're about to enjoy. So, Dr. Michio Kaku is one of the world's most widely recognized figures in science. He has written 5 New York Times bestsellers. His latest bestseller is The God Equation, The Quest for the Theory of Everything. I think I read that. I'm pretty sure I read that, and I very much enjoyed it. He's the science correspondent for National CBS This Morning TV. He has a weekly science radio show that is heard in 100 cities across the country. He has 4.5 million fans on Facebook, and more than 1 million people follow him on Twitter. So we're talking about a real science superstar here. He has hosted numerous science specials on the Discovery Channel, Science Channel, BBC TV, and has appeared on The David Letterman Show, Good Morning America, Today Show, CBS Late Show with Stephen Colbert, HBO, and The Stephen Colbert Report, CNN, The History Channel, PBS TV, National Geographic, and all the major news media. I don't think I left anyone out there. He was recently chosen as one of the most influential physicists in the world today by Academic Influence. He graduated summa cum laude in physics from Harvard in 1968, graduating first in his physics class, which is to be expected given his profile. He received his PhD from the University of California at Berkeley in 1972, and he has taught at the City College of the City University of New York for 45 years. There's still more to come. He holds the Henry Samat Chair in Theoretical Physics at CC in New York, and he has written for Time Magazine, The Wall Street Journal, Astronomy Magazine, The London Times, Daily Telegraph, and many other international newspapers. He frequently keynotes major business conferences about the next 20 years in computers, finance, banking, and commerce. And we're hoping that his conversation with Lance Braunstein will really enlighten us today and give us a vision in what is to come with these technological disruptions in the world, and especially in Latin America, which is what we're interested in. Now, whilst we still have a second, I'm also going to tell you a bit about Aladdin Enterprise from BlackRock, where Lance Braunstein is head of product. Aladdin is an operating system for investment professionals that powers every aspect of the investment process. So you can see we're talking about technology, and I think that fits in well with the conversation we're about to have between Lance and Michio. The Aladdin software is an end-to-end portfolio management software that combines sophisticated risk analytics with comprehensive portfolio management tools, trading, operations, compliance, and accounting tools on a single platform. With a single standardized data set, Aladdin brings clarity, efficiency, scalability, and cost savings to the entire investment lifecycle. Aladdin's native risk analysis makes Aladdin a truly end-to-end platform. Aladdin drives collective intelligence, providing tools to help organizations communicate effectively, address problems quickly, and make informed decisions at every step of the investment process. As an end-to-end investment platform, Aladdin and Aladdin Wealth are relied on by approximately 55,000 investment professionals around the world, powered by more than 1,500 developers focused on continuous enhancements that are made available to all clients. Delivered as a hosted service, including the Aladdin technical infrastructure, system administration, and interfacing with data providers and industry utilities. BlackRock operates a data and analytics factory with more than 600 professionals focused on creating and quality controlling data and analysis for clients. BlackRock also supports business process design and implementation, third-party data sources and middle office operations, data management, and system configuration services. So you can say that Aladdin is a flexible solution for the entire investment process across all asset classes, including alternatives. Now, I think we're almost ready to go back in the studio in New York City. So I'm just going to check in and see if we can get live with Lance and Michio. Yes, I think we're good to go. Michio, I can hear you coming through clearly. Lance, okay. Are you able to hear me?
I am here, yes.
Wonderful, Lance. So I think we're just about ready to get started. Are you able to hear Michio fine?
I can hear you.
Michio, nice to see you.
Okay, very good. I can hear and see you.
Nicholas, I think back to you.
Yeah, no, I think we're good to go. I think the audience has seen plenty of me over the last day and a half. So I'm now going to hand over to you, Lance, so you can lead your conversation with Michio. The audience is all yours.
Thanks, Nicholas. And hi, everyone. I'm Lance Brownstein. I'm a member of the Aladdin team here at BlackRock. And I have to say it is a true honor and privilege to be here today with Michio Kaku. I'm sure he doesn't require an introduction, but I'm going to give a little bit of one anyway. Michio, as you probably know, is a researcher in a variety of topics, including string theory, quantum mechanics, and also an author, and most recently a bestseller, a New York Times bestseller author of The God Equation. And again, a true privilege to be here today with you, Michio. Let me pass it to you, perhaps for a few prepared comments, and then we could go into a bit of a Q&A after that.
Sure. Because we're talking about wealth and finances, I'd like to start by asking the question, where does wealth come from anyway? If you talk to a politician would say, oh, that's easy. Wealth comes from taxes. You tax Peter to pay Paul. But you see, that rearranges wealth. That doesn't create wealth. If you talk to an economist, surely they know where wealth comes from. An economist would say that wealth comes from printing money. But you see, if you print money, money becomes worthless. And so that's not where wealth comes from. Now, I'm a physicist. We believe that wealth comes from science and innovation. Starting about 200 years ago, we physicists worked out something called thermodynamics, the laws of heat. That gave us the steam engine, which gave us the locomotive, which gave us the factory. And that initiated the greatest revolution in human history, the Industrial Revolution. And then, a few decades after that, we physicists worked out the laws of electricity and magnetism. And that gave us dynamos, it gave us generators, it gave us television, radio, the light bulb. And then, after World War II, we physicists applied the quantum theory to give us the transistor. And that gave us the computer, the laser, the internet, the modern age. And now let's talk about the fourth wave of wealth generation. I say the fourth wave of wealth generation is physics at the molecular level. That is artificial intelligence, which we'll talk about. Also, biotechnology, and nanotechnology. And now I like to look at my crystal ball and look at wealth generation by mid-century, by 2040, by 2050. There are several technologies racing to get out of the gate. First is fusion power. Believe it or not, we physicists hope to achieve break-even for fusion power in the next 3 years. And by mid-century, we should be able to put the sun in a bottle. Also, quantum computers. Silicon Valley could eventually become a rust belt because we're going to be approaching the end of the age of silicon, and we're going to have to go to quantum computers, which compute on individual atoms. We already have prototypes of quantum computers. And third, we hope to have BrainNet, the connection of the mind directly to the internet, where you simply think telepathically and communicate and control the internet. But right now, we're entering the fourth era, the era of artificial intelligence. And we're going to see that everywhere we go in our daily life. For example, when you want to see a doctor, you will talk to RoboDoc. RoboDoc is in your contact lens. You simply blink, and there is RoboDoc accessing the entire medical literature, giving you sound legal advice. And when you want to talk to a lawyer, you'll talk to RoboLawyer inside your wristwatch. Anywhere you go, you'll be able to have expert legal advice. And so the point is that artificial intelligence is going to be everywhere and nowhere. And this is going to affect the job market. It's going to affect wealth generation. It's going to affect prices. Things are going to be cheaper. We're going to have more and more access of basically infinite amounts of information. And so these are just some of the enormous developments that we expect to see in the fourth wave. Oh, by the way, medicine and biotechnology is also being revolutionized. In the future, when you go to the bathroom, your toilet will analyze your bodily fluids and tell you that you have cancer or have cancerous cells and cancer colonies growing in your body. In other words, the word tumor could disappear from the English language. Once we have your toilet connected to the internet, analyzing your bodily fluids for cancer cells, cancer colonies, cancer enzymes, perhaps decades before cancer forms. So these are just a few of the miracles that await us in the era of artificial intelligence.
Michio, that is both an exciting and a bit of a scary future, an internet-connected toilet. But I'm curious, when you think about this fourth wave, which is a fascinating concept of wealth creation, can you maybe expand on how you think of that changing the way we invest, how it changes sort of the foundations of finance?
Well, first of all, you have to realize that when you invest in things that generate prosperity, to generate wealth. Now, of course, some people invest in Bitcoins. I have nothing against that. However, of course, you're not betting against something that has value. You're not investing in something that produces something. Now, some people say, well, the stock market, isn't that gambling? Isn't that like slot machines? Well, in some sense, yes. But you see, you're investing in value, things that create value for society. So corporations, yes, you gamble on these corporations, but you're gambling on things that produce something. Bitcoin, on the other hand, and again, I have nothing against those people investing in Bitcoin, but Bitcoin does not create wealth. It's not a wealth generator. And I'm a physicist, and that's what we believe in, wealth generation, by harnessing the laws of physics in order to create wealth that enriches society. And so that's why I think that, yes, we have to understand the origin of what produces prosperity.
And Michio, in that vein, I think it's interesting to think about a cryptocurrency like a Bitcoin, Ethereum, or Ether. What about the notion of decentralized finance? This idea that Web 3.0 is largely taking out intermediaries and the blockchain is going to allow us to interact very differently, again, in the spirit of investing differently and counterparties interacting differently. Do you have any thoughts on this notion of Web 3.0 beyond simply cryptocurrency?
Well, the web is going to be everywhere, and it's going to eliminate many layers of unnecessary steps, and it's going to make society more efficient, more streamlined, and I think that's a good thing. So what is good about the web, and of course there are bad aspects as well. What is good about the web is it's going to eliminate layers of redundancy, which is going to improve efficiency, making life more cheaper, more accessible, and available for everybody. However, of course, everything can be misused as well. And so we have to take that into consideration as well.
It's interesting. I actually want to touch on that notion of the potential for misuse. And we've heard a lot of negative press about big tech and the ways in which information is used. Do you have thoughts as we go into this world where my contact lens or my watch provides very, very kind of intimate and private information to a host of people? Do you have thoughts on how do we protect privacy and how do we protect sort of liberties, in a sense, in that world where tech becomes much, much more of an intimate set of capabilities in our lives? Our toilet, for example.
Well, everything has a plus and a minus. When we humans harness the power of bows and arrows, that allowed us to hunt game and enrich food supply. But of course, bows and arrows could be used to kill people as well. And so I think we have to realize that with the internet, the downside of the internet is privacy, in the sense that some of your intimate thoughts, your transactions will be a matter of public record. And so I think that's something that has to be taken into consideration. And I think that with regards to the web, I think that our etiquette is going to have to change too. Teenagers, of course, put everything on the internet, and their antics of the teenagers are going to haunt them when they apply for a job, when they enter the job market. Yes, the person interviewing you for a job is going to have access to all the videotapes that you made as a teenager and all your antics. And so I think our etiquette is going to have to change. We're going to have to be a little bit more private when we put things on the internet. And I think that, of course, criminals can take advantage of this, and we're going to have software that protects us, even in spite of our own natural tendency to talk too much, to give too much information on the internet. We need software to safeguard us from the fact that, yes, privacy is one of the big negative aspects of the internet.
Look, as a parent of a teenager, I think a lot about the digital fingerprint that you just described and the idea that that will follow you in an almost immutable way. So where those protections come from and how that etiquette evolves is going to be quite interesting. I don't think it necessarily will source from the big tech firms. I think whether it is a societal shift, behavioral shift at the individual level, regulatory, legal protections, et cetera, I do think that there's going to have to be a sea change in how we interact. If I could pivot for a moment, when I think about enabling some of these big seismic shifts in how we interoperate, how do you think quantum computing plays into that? This is giving us sort of a next many order of magnitude capability in terms of compute. Where do you think that plays both generically across all of these societal shifts, but then in particular, if you could touch on the impacts you can see in finance?
Well, we're used to Moore's law that every year computer power doubles every 18 months or so. And we buy new products, we upgrade. That keeps the economy going. But let me ask you a question. Would you buy a new computer knowing that it's just as powerful as last year's model and there's no increase in power of the technology? Maybe not. And that means that Silicon Valley might become, in some sense, a rust belt as we approach the end of Moore's law, which is happening now, by the way. Already you can see the fact that Moore's law is winding down. The smallest transistor is about 20 atoms across. And when it is 5 atoms across, then of course you get leakage, quantum effects occur as a consequence. And the chip basically melts because of a meltdown in power consumption. And so we're going to have to go to quantum computers. But quantum computers compute on atoms. They're not ready yet. They're still in the experimental stage. However, we have quantum computers that are in operation. You can get on the web right now and get into several servers which allow you to play with quantum computers right on your laptop. And so quantum computers are here. It's not science fiction, but the power of quantum computers is perhaps 10, 15 years still in the future. And of course, one group to worry about these things is the CIA. Quantum computers eventually could be so powerful it'll break any of the codes that protect your bank accounts and your internet transactions. And so that's going to create a big headache for those people involved with computer security.
Yeah, you do worry about crypto in a world where a quantum computer is many orders of magnitude ahead of what we have today in terms of compute. Do you imagine in finance a set of use cases like being able to run a different quantum of Monte Carlo simulations, for example, as being a shift in how we interact with markets? Is that one of the ways or one of the use cases that you imagine will fundamentally change in a world where quantum computers are like present and active in our lives?
Right, I think so. You see, whenever we make projections on the market, we have to make approximations. We have to guess. We have to look at previous transactions and previous trends, and then basically guess how they will proceed into the future. Look at all the algorithms used by financial institutions. They're based on assumptions. However, quantum computers allow you to reduce the number of assumptions to make your estimates much more realistic. So, for example, is a corporation really making money or not? It's difficult because you have so many parameters involved. Quantum computers will allow you to manipulate a vast number of approximations and different parameters to give you a much more accurate assessment of where the market is going. A lot of the guesswork, a lot of the approximations will be eliminated. And that's the beauty of quantum computers. We'll be able to vastly increase the number of parameters that we work with, so that these algorithms of today, which are kind of primitive, will become very more accurate in the future.
Yeah, which is a very cool prospect, and I imagine has application in many, many other fields. I think about climate science, for example, the world of global climate modeling. That relies on massive parameterization and simplification of physics equations. In a world of quantum computers, that obviously will change, and we'll be able to do much more of the science.
Exactly. You realize that when you start to model the weather, you have to make enormous approximations. For example, the jet stream. The jet stream determines the weather over most of North America, but we have to guess. We have to guess what the jet stream is going to be, and that you do with the flip of a coin. And also, you have to divide the entire globe in terms of squares. You approximate the Earth by looking at thousands and thousands of squares. How big are these squares? Several miles across. That means that you are approximating the weather, which of course changes every few hundred feet, with miles of approximations. And so you can see where a lot of the mistakes are made. Whenever a hurricane, for example, travels across the Atlantic, many computer programs try to figure out where the hurricane is going to go, and they often disagree with each other. They disagree with each other because they make approximations, and that's where quantum computers comes in. It allows you to get much more accurate predictions of the future of the market, the future of the weather, the future of the hurricanes. It increases the number of parameters that you can put into a computer program.
It is a bright future, and one that I think we'll have to be careful about in terms of things like privacy, security. Obviously, this will be an evolving landscape. I'm going to pivot a little bit. You talk about AI, augmented reality, virtual reality. Can you share some of your thoughts on, again, how these technologies will play into finance and how we create, in this next wave of wealth, how we create real value versus sort of the proxy, how we think about AI truly creating value in markets?
Well, when you think about AI and you think about markets, you realize that your markets are only as good as the algorithms and approximations that you make. And it depends on the number of parameters that you put into your program. It depends on how you massage these parameters in an algorithm. And then you begin to realize, my God, we're making an enormous number of approximations. We're doing a lot of guesswork. And that's where quantum computers comes in. Quantum computers allow you to manipulate vast amounts of raw data. Now, just remember that 100 years ago, people liked to have lots of oil and gold and minerals. But the gold of the future will be data. And data has to be massaged. It has to be analyzed. And heuristics, of course, allow us to give a partial preview of where the data is taking us. Quantum computers will give us a much more accurate reading of the future. It'll allow us to, in some sense, have a better crystal ball to predict where the markets are going. And it'll eliminate a lot of the guesswork that we find in computer models of today. And so I think that's where the gold is. The gold of the future is going to be data, and quantum computers will massage that data to give us much more accurate predictions of where the market is going. And so a lot of the guesswork is going to gradually be eliminated.
We're seeing, even before quantum computers, we're seeing the power of machine learning and artificial intelligence in so many different applications, whether it's virtual assistants or how we think about, operational activities. Do you think that continues in the exponential way where we train computers to learn over time and that we truly create artificial intelligence? Or do you think that that is going to rely on a quantum shift in our compute capability and our data management capability?
Well, we have to realize that there are stringent limits on what we can do with artificial intelligence today. In fact, there are three kinds of jobs that will survive for many decades in the future. They will not be replaced by artificial intelligence. The first is, believe it or not, a non-repetitive blue-collar work, picking up garbage, being able to sweep the floor, things that we take for granted, like fixing a broken toilet. The most advanced robot on the earth cannot fix a broken toilet. And so non-repetitive blue-collar work will survive. Plus, second, human relations. People involved with sizing up people's problems, counselors, advisors. These jobs cannot be done by robots because robots are clueless when it comes to understanding people's emotional state, projecting the future of a person's abilities. Human interactions cannot be modeled by computers. Third is intellectual capital. That is, people who look at forecasting the market, people who are, quote, captains of industry, people who look at data and strategize. Robots cannot do that. Robots cannot strategize where a corporation should be going with investments. And so these are the three areas where there's going to be plenty of jobs available into the coming decades, because robots are, we forget this, robots are basically sophisticated adding machines. They add 1 million times faster than us, giving us the illusion that they are original, that they are thinking, but they're basically very sophisticated adding machines. Now, that doesn't mean that one day they'll be able to replace humans in many, many kinds of jobs. But right now, there are three major categories of jobs which cannot be replaced by artificial intelligence.
Michio, I'm curious, what in the next 5-10 years, what jobs do you think are replaced? Like, where do we see robotics really playing the proxy role to humans? Like, where does that happen?
Jobs that involve repetitive work are going to be jobs that are going to be replaced because that's what robots do. They make the same repetitive motion over and over again. However, this also means that certain jobs are going to be impacted by this. If you're flipping hamburgers, for example, realize that in Japan, there are robots now that can make noodles in 1 minute and 29 seconds. You ask for noodles and a robot prepares the noodles. Now, at the high end, when you want to go to a luxury restaurant and you want to be catered to, humans will be there even in the age of robots because people want to be pampered. They're paying for the pampering. But if you want a quick hamburger, chances are that some of those jobs will be replaced by robots that can flip hamburgers faster and more efficiently than human. So those are the jobs you have to worry about. Also, nurses in hospitals. A lot of the menial work that is giving medicines to patients at 4 o'clock in the morning, a lot of those jobs will be done by robots that's scurrying around hospitals, taking out orders, delivering medicines, taking people's temperature, things that are repetitive and doesn't require judgment. Those jobs are going to be replaced by robots.
Very interesting. So if I sort of pull everything together, you speak a lot about the theory of everything, this unified theory, and it is certainly part of your last book. I'd just be curious if you could take all the ideas that you just shared with us in the last 20 or so minutes and perhaps kind of zoom out to this theory of everything idea and just share with us, like, what does that mean to you? And, how are you spending your days expounding on that theory of everything?
Yes, people ask me, well, what do I do for a living? Because, of course, it's very difficult to be a futurist and get paid for it. I'm a professor of physics, and I work on what is called the unified field theory, string theory, which we think is the theory that eluded Einstein for the last 30 years of his life. Einstein said that he wanted to read the mind of God. He wanted to understand where the universe came from, a single equation that would unify all the laws of nature, and we think we have it. The paradigm is music, the music of tiny little vibrating strings. Each vibration corresponds to a subatomic particle. So this would be an electron, this would be a quark, this would be a meson. Different vibrations of a tiny string gives you all the subatomic particles. So the particles of nature are nothing but musical notes on a string. What is physics? Physics is the harmonies you can play on vibrating strings. What is chemistry? Chemistry is the melodies you can play when these strings bump into each other, creating molecules. What is the universe? The universe is a symphony of vibrating strings. And then what is the mind of God that Albert Einstein spent so many decades chasing after? The mind of God is cosmic music resonating through hyperspace. That would be the mind of God. And that's why I wrote the book, The God Equation, in order to impart the excitement that we physicists feel that finally we could be, we're not sure, but we could be closing in on the fabled theory of everything.
And when you say closing in the next number of years, you think we derive the God equation? Do you think that is imminent and in our lifetimes?
It could happen any moment. We have the basic equations of string theory. We have to pull it together into a coherent theory. Maybe somebody watching this program will be inspired to find the theory of everything. And I give them a word of advice. If you ever find the theory of everything, be sure to tell me first. And we'll publish together and we'll share the Nobel Prize together.
Well, Michio, I hope for your and their sake that happens. And I'm curious, just in the spirit of, your musical metaphor, are you a musician? Like, have you taken inspiration from music in your life as you develop this string theory?
Well, yes, I've played the trumpet all my life. However, now I live in Manhattan, and it's impossible to play the trumpet in Manhattan without all your neighbors complaining. So I've had to drop that. But yeah, music, we think, is the metaphor. Music is the only metaphor rich enough to explain all the diversity, the rich diversity of all the atoms, molecules, all the things that we see around us. What other metaphor is rich enough to do that? And so it's the music of tiny vibrating strings that give us the subatomic particles that give us what is called the quantum theory, which will eventually be the basis for Wall Street as Wall Street converts to quantum computers.
Yeah, it's fascinating as somebody who is a music lover, this idea that there's a unified string theory that then informs quantum compute, that then informs our ability to think about AI as a next gen, which then informs our ability to think about, algos and our quant abilities very, very differently from how we do today, and how that fundamentally changes the internet and finance. It is a fascinating chain of logic. And for folks who have not read The God Equation, it's a great read, Michio. It's a very fun set of ideas to play with. We're coming to time, and so I did want to ask, is there anything else, are there any other ideas that you would share with our audience that is not in the scope of what we've discussed in finance specifically, as a closing set of comments?
Well, when I was a child during the Cold War, people sometimes talked about the sick man of Asia, that China, India had so many people, it was a drain on the economy. They would always be the sick man of Asia. No one talks about that anymore. Why? Education. When you educate a peasant, instead of becoming a drain on society, they become an asset. And so that's the key. Now, I grew up in Palo Alto, which is right next to Stanford, which is, of course, one of the centers of Silicon Valley. I saw Silicon Valley erupt from nothing. How did it happen? First, you have a great university, Stanford. Second, you have a team of graduate students with energy and vitality, bursting with ideas, graduate students that then became CEOs of new corporations. Third, tax laws. The government eased up on taxes and encouraged these entrepreneurs to set up companies, and boom, before you know it, you had Silicon Valley. So this is something that other countries can also duplicate. You can duplicate this by having centers of learning, by having a culture of young innovators that want to start a corporation, tax laws that encourage these people, and before you know it, you may have a Silicon Valley of your own.
That is a great prospect, and apropos to this client forum specifically. And with that, I think we are at time. Michio, thank you so much. Thank you for all the work you've done in research and for your popularization of science. I think you've made it accessible to many of us non-scientists. And thank you for taking the time today. And with that, I'm going to pass it back to Nicholas.
Hello again, it's me, Nicholas, back here in the Mexico City studio. Many thanks to Lance and Michio for that fascinating conversation. I'm now very much looking forward to our next session, and I'm delighted to have the ability to speak with Karina Sage, Country Manager of Brazil at BlackRock, and Louise Cooperstrom, Chief Strategy Officer and Interim CMO at Betterfly. We're going to be discussing disruptions and why they are important in Latin America. Karina, Louise, it's great to be here with two leaders in their respective industries. Could you get us started by introducing yourselves? Louise, let's start with you.
Yeah, hi, everyone. My name is Louise. I am Swedish, actually, but working in one of the fastest growing companies in Latin America. As Nicholas mentioned, I'm the CMO and Chief Strategy Officer for Betterfly. And I've actually been with the company since the start when we were Burn to Give in a different iteration of the company. And before that, I had the great pleasure of working with Karina. In somewhat coincidentally, we're in this conversation together, but it's great to see her again. And we kind of professionally grew up together at BlackRock. I was there for over 9 years.
Fantastic. Karina, do you want to introduce yourself as well for the audience?
Hi, Nicholas. Thank you, everyone, for having me here. Good to see you, Luis, even if virtually again. So I'm currently the country manager of our Brazilian business. I've been at BlackRock for 15 years now. I like to say that I started when I was 12, just so I don't fully date myself. I've had a very nonlinear career at BlackRock. So even though I've been at the firm for most of my career, I've worn many different hats. I started out in our fixed income investments business. I moved out to our product development team. Then I spent some time as part of the senior management team for the Latin American business. And now I'm leading our commercial efforts in Brazil. So it's been an exciting ride. Really excited to be with you guys today. Now, I should note that you can see in the back of my background, you can see pictures of who my real bosses are. Those are my 2 children. So I have 2 boys. One is 5 and one is 3. And those are the ones I really follow on a day-to-day basis, irrespective of what's going on in my career.
Wonderful, Karina. Thanks for sharing. Luis, I'm going to come to you for the first question. I'm usually based in Chile, currently in Mexico City for the event, but I'm usually based in Chile, so I'm well aware of Betterfly and its growth and a bit of the hype around it. Can you tell us a bit more about the story of Betterfly, its growth, and its mission in the region?
Absolutely. So I think actually the best way of describing what Betterfly is, because we get that question quite a bit, is to just tell the story of how this company came to be. And if you were based in Chile, you may have come across us in a different version, which was Burn to Give. So the first concept that we started with was this idea that you could exercise and give those calories that you spend exercising to someone who needs them, right? Burn to give. And it was a really simple concept that resonated with people immediately. When you described that, people completely understood what it was. And we started with an MVP almost 4 years ago. And the first MVP that we did, we had 200,000 people joining that MVP. And we realized at that moment that this concept of it's more powerful to do something and help someone else than to help yourself. And that we kind of just went with that. We never had an idea of how to monetize this concept. We just knew there was something there. And as we continue to talk to individuals, to companies, et cetera, we started looking at a slightly different problem, which was a lot of companies were interested in our concept, but what we realized was that for employees in Latin America, only 5% are offered benefits. So that's how we entered into this benefit space, where the idea was that can we create an all-in-one platform that would give people the opportunity to have access to tools that could help you improve your physical well-being, your mental well-being, and your financial well-being, while also helping yourself, your family, and the community, right? So having this intrinsic motivator that is maybe bigger than yourself. And when we're coming to the helping your family, the concept was really, can we create a life insurance product that grows with your healthy habits? So not only does everything that you do on the platform help yourself, but it increases life insurance coverage and also earns you what we call better coins that you can donate to social causes of your choice. So that's how that idea has evolved. And I'm sure there's, this is just the first iteration. And when we launched the benefit platform, we became Betterfly in November of 2020. And since then, we celebrated our anniversary last year. And at that point, we had 2,600 clients. So you can imagine the absolutely explosive growth and what that means from needing to onboard clients per day. So, when we started the company, we were 10 people. We're now almost 600 people. So it's just been an incredible journey. And we are just very recently joining Karina in Brazil. So we launched in Brazil in November, and we're launching now Mexico and Ecuador in May, and are aspiring to be in all of Latin America by end of year.
Wow, it's a very inspiring story. Everything seems so positive. My girlfriend actually uses Betterfly at her startup, so I've been able to see firsthand how it's useful for smaller companies as well. So we're talking a lot about there's a lot of technological disruption there in what Betterfly is doing, and technology is key to enabling all these people to onboard and to quickly grow to new markets. Carolina, question for you. How would you say BlackRock is using technology to disrupt and to increase inclusion across the region?
I think that's a good question. It's funny, as Louise was going through the story for Betterfly, I actually saw so much of it resonate with our mission at BlackRock. There are so many parallels, right? This idea of helping others achieve well-being. In our case, it would be financial well-being, but certainly contributing to the community that you serve. That's really a big part of our mission. And technology is a big pillar of this, of how we're looking to achieve this. So when you think about what's going on in Latin America, you've seen an explosive growth in fintechs. And what they're doing is really democratizing access to investments. And BlackRock obviously has its own technology platforms, but is also working with fintechs across the region to be able to allow them to provide investments to underserved parts of the population that didn't have access to these investments before. And that's particularly meaningful in commodity-based economies where there's a lot of volatility. Investments provide a different income stream and helps shield some of these individuals from that volatility. And so BlackRock's really working with fintechs in many different ways. We're providing financial education to their end customers to help drive financial inclusion. That's a big part of our mission, helping to improve investment literacy. We're obviously working with them to be a preferred provider of investment solutions across many different products, iShares, mutual funds, model portfolios. And finally, we're helping to use technology and to leverage technology to improve operational efficiency at these fintech companies. So they're really leveraging a lot of what we've learned with technology to be able to improve their access and to be able to move into a new vertical. So a lot of these companies started in banking and payments, and they're just legging into investments in new verticals like insurance. And we're allowing them to do this more efficiently.
Thank you, Carolina. Louise, could you speak a bit more to how Betterfly is using technology to push inclusion and also a bit about how you're driving diversity in the company and around the region?
Absolutely. I mean, I would say the platform is based on providing access, improved access to all populations that are underserved, right? So that includes women in many cases. If you look at those who have traditionally had life insurance, those who have traditionally had access to benefits, women have been underrepresented in those groups. And not only women, but speaking of diversity in a broader sense, minorities, people of color, et cetera. So providing something that could democratize access is incredibly important. And technology obviously allows you to do that, right? So part of what we can do that we wouldn't have been able to do without technology is aggregating services and being able to offer those in a really cost-efficient way. So in Chile, our product costs $4 per member, right? If you think about what you get access to there, you get access to meditation, to gyms, to financial services, to all types of things that would allow you to live a healthier life, both physically, mentally, and financially. And being able to aggregate those services means that we can do that at scale and also offer it at a lower cost, right? So that's really the powerful part of technology. It also allows you to bring people along on a journey. So you may start this journey by taking a few steps or walking, but as you're on that journey, we can help you increase your awareness around the importance of mental health, right? Which is deeply connected to financial health. And so we can think about wellness in a very holistic way in that we can have touch points across that journey. So all of those things are really important, right? It's, but I would also say that having access to that data is a huge responsibility for companies. How we treat data, how we use data is incredibly important. And it's something that for us has become quite difficult because there's a lot of suspicion around how companies treat data. And for us, we've made a clear stance that we will never sell any data. Our revenue model is based around that. Yeah.
At the end of the day, the ads, someone's going to offer, that targeting that will be available. So that's something you're not planning to do.
No, so we kind of come out strong and said, look, we're never going to sell data because it has been a way, I think, especially in the last wave of technology companies that, there was the saying that data is power and it is, data is power, but that power comes with a sense of responsibility, right? And you have to take that responsibility really, really seriously, especially when you're doing things around health and financial services. So we had to build a revenue model that did not require us to do anything with the user data, and that the user data could remain the user's data. So, that's a really important piece. And this is provided to users either through their employers or through the insurance company that pays for it. The user never pays, but obviously there's a very huge benefit for them to be able to be given these products, maybe for the first time in many cases. So this is a really exciting way to be able to offer this at scale to people who may not have had access to, especially life insurance, I would say, which is a product that has traditionally been sold, not bought. And hence, the person who would receive that call was probably quite wealthy.
No, definitely. It sounds very interesting. And I think it speaks well to that point about inclusion, and bringing these to more people and across societies in Latin America. Cardina, I wanted to ask you about specific inclusion initiatives you might have at BlackRock currently that might be similar or that might have similar goals as what they're trying to achieve at Betterfly.
Yeah, absolutely. So I think BlackRock really thinks about inclusion in two different ways. I think we think about what we can do to improve inclusion within the company, but also to improve inclusion in the communities that we serve, right? So we've been talking a lot about technology democratizing access to investment, but let me take it a little bit differently. Let's think about how we include underrepresented groups in the conversation. So BlackRock has been doing a couple of things. Let me call out some of my colleagues in Mexico, for example. We've been working very closely with some organizations like Laboratoria in Mexico to improve the representation of women in technology jobs. So Laboratoria provides training for underserved females who have never had access to technology training, and then helps to place them in technology positions. So helps improve the representation of women in technology industries, which we know is an industry where, much like financial services, females are dramatically underrepresented. BlackRock has a number of sponsorship programs to help advance the career of women across the company. We know that we do a really good job recruiting women, but we do a very poor job over time in financial services retaining women. And ultimately, we have very low representation of females in senior management positions, in board positions. And so it's really about how we can take an over-mentored community, but under-sponsored, and increase the sponsorship model. And some of the conversations we're having there is really about how to think about a continuing of sponsorship options, where it's not all or nothing. It's many different ways a sponsor can act to help a female advance within the company, first as a connector, then as an influencer, and ultimately the leg end into a full-blown and very authentic sponsorship model that lowers the barrier to sponsorship within the company. And that's really what we're looking to do, get a higher number of female individuals, female talent, with some degree of sponsorship within the company.
So I have to just jump in here because having worked at BlackRock, I was a recipient of many of these services. And I feel very privileged to have been able to work for a large company that had the resources to do that, and was very, very thoughtful about how do you identify talent? How do you grow talent? How do you connect talent with others, right? And really take, I think what BlackRock did really well was take huge bets on people, right? It wasn't that, you necessarily needed to have done the role to be able to be given the role. I think they really was comfortable taking large bets. And that's absolutely required if you're thinking about how to make your leadership more diverse, is that sometimes you're not going to find the perfect person. You're going to have to just trust that the person comes with the right set of thoughts and abilities to be able to do a job, even if it doesn't look perfect on paper. And I have to say, as a startup, this is actually really, really hard because you can imagine, right? You're trying to grow from 10 people to 600. How thoughtful can you possibly be in those decisions? BlackRock, when we were talking about how to increase participation of women in leadership positions, we're thinking about how do we identify 5 women in each of those positions who could take the job when it becomes available, right? This is not possible for us to do. We're just like trying to hire as many people as we can. We call all of our friends. And so it becomes this virtual cycle when you have women in the company, because what happens with networks is that you tend to have people in your network that look and feel like you, right? So once you hire that first woman or the first person of color or what it is, you all immediately be given access to a group. And the most difficult thing is to break through, is to find that first person that you trust, who's going to be able to hire more people, who are going to be able to convince other people to join. And so this is, we actually put a statement out there that by end of year, we want 50% of women in our leadership positions. This is incredibly hard, but if you don't make that statement, no one's going to get it done, especially when you're just like trying to get through the day, right? So but it is making sure that at least in those first few hires, you get women in those positions, because it's going to give you access. And it keeps on rolling once you have that access.
And it's interesting, Louise, as I hear you talk a little bit about BlackRock making bets on people. So when you look at my career, I think I'm very much an example of that. So when I talk about a nonlinear career, it's really about moving into positions, right? There's a lot of mobility here that was involved, but moving into positions where I had no prior experience. And BlackRock was willing to make that bet. So taking on a product development role with no prior product development expertise, taking on a COO role with no prior COO expertise, but you have to be willing to allow talent to do that. You have to be willing to foster that mobility and really be able to develop more horizontal leaders as a result of this. And of course, thinking about how to do this with, underrepresented populations like females, like certain racial minorities. And of course, how we define diversity obviously is ultimately a question here, but being able to foster that opportunity more broadly.
And that is also putting people in a role and then not just sitting back and kind of seeing what happens. You have to be very thoughtful about that, right? It's about what kind of mentorship and guidance can I give you to make sure that you are successful in that role. So that's not the end, right? And it is hard. I think everyone that had the privilege of working at BlackRock were challenged in ways that they never expected, but I'm sure appreciated. And I think that what I really appreciated was that my colleagues rallied around me when I was given those type of roles, and actually at Betterfly, because if you look at what I've done at Betterfly since I joined, it's vastly different things. And it's about support. It's about making resources available. It's about taking time to provide advice, taking time to create a network of advisors that are maybe not in your company, but that could help you grow into that next role. And all that.
I call it a board of directors, right?
Yeah.
A board of directors, your own personal board of directors to help you.
Wonderful. No, I mean, these are great insights. I don't want to interrupt here because I'm trying to learn. Bloomberg Linea is also in sort of startup mode. So I'm kind of thinking of how we could start incorporating some of these policies in our own growth over the next few years, because it's so relevant. And I'm just trying to take it all in. We're starting to sort of come to the end of this sort of discussion that we've had today. Louise, I don't know, is there anything else specific that you'd like to share about the Betterfly story, about your own story of BlackRock before we close out this brief discussion?
You know what? I always like to think about what we can do collectively as a group, right? Which is kind kind of the basis of our product and what we're trying to build. So what you think about what you can do for yourself, right? You, as a woman, you can grow your own career. As a person, you can improve your own health. But it's really important to think about how you amplify those things, how you pay it forward. And as a technology, we call ourselves a multiplier, right? We multiply many people's effort into a large collective effort, which is quite incredible when you look at the numbers, right? It's collectively, just in Chile, let me see if I can actually find the data here. So collectively, the users have donated 350,000 meals to children, 120,000 liters of clean drinking water, 150,000 trees, and have increased their life insurance coverage by over $1 billion. And all those things are small on an individual level, but are huge on a collective level, right? So can you imagine what would happen if people who truly cared about things start thinking about how to create those collective networks, right? And this is so important for women as well. And anyone who's trying to drive diversity, it's not just about your own journey. It's about how do you make that connection, right? And how do you, I love the fact that I worked with Karina, because she was one of those people that I really looked up to. And when you talk about your own board of directors, I would call her and get advice. And those are really important things, pay it forward, pay it back, all those things. It's so anyone listening, I just encourage you to think about how to do that, because we are all in a, even being on this call, you are probably in a position of privilege. So just take a moment to think about that. What can you do today to help someone else?
Thank you so much, Louise. Great message, and thanks very much for being with us here today. You've been going out live across Latin America, and I hope lots of people in the audience have been able to enjoy your insights and hopefully take something away from them. So thank you very much.
Thanks for having me. It was a pleasure.
Wonderful. Karina, going back to you, we're coming to the end of our 3-day event. So I just wanted to come to you for some closing remarks on today, on your conversation with Louise, and perhaps as the event as a whole.
Wonderful. Thank you, Nicholas. I want to thank everyone who followed the last 3 days of our event. This journey was all about challenging our existing mindset about investing. On the first day of the event, we reviewed markets and geopolitical trends with our founder, chairman, and CEO, Larry Fink, and other great minds from our BlackRock team. They shared their perspectives on the growth of capital markets, the role that emerging markets play in investments today, how to live with inflation, and the transition to a net zero economy. Rick, in particular, shared his views on how rates might not end up being as high as folks expect, but might likely stay higher for longer. On the second day of the event, we brought not only our founder and president, Rob Capito, to the conversation, as well as other friends from BlackRock, but also some of our partners like Morgan Stanley, UBS, Itaú, and Protección, highlighting how ETFs and other innovations promote the democratization of investments across Latin America and how they change the way we think about wealth. Today, we talked about how technology is revolutionizing the financial services industry and how we are part of this revolution that is evolving very quickly. We started by discussing how technology is enabling wealth managers to evolve their business models and to better serve a broader set of end clients with evolving needs. We talked about how the winners in the industry are not only being ruthlessly clear about the client segments that they serve, but also using technology for scale and client journey management, and how they're also building flexibility into the client service model to make it multi-channel. We heard from best-selling author Michio Kaku about how the digital economy is everywhere and impacting everything. And we also heard from Louise and myself about how technology is democratizing access to financial services. Now, our exchange doesn't stop here. We encourage you to stay connected with BlackRock via our social media channels, and we recommend that you listen to our podcasts, The Bid, Encuentro, and the 3-part series of The Real Leaders of Net Zero with Mark Wiedman. I would like to thank our partner, Bloomberg Linea, for this event and all BlackRock teams involved, and thank, most importantly, our audience. And we hope to see you next year at the next Latin American Forum. Have a great day.
Thank you so much, Carina. And that brings us to a close. I would also like to thank all the fantastic speakers who've joined us over the last 3 days for their excellent commitment and really excellent content. I would also like to thank Fernanda Cruz and the marketing team at BlackRock for all their effort, coordinating and curating this top quality content. A special shout out to the team here at Bloomberg Linea for their efforts producing and transmitting this event in sometimes adverse circumstances. Lastly, I want to thank you, the viewers. Currently, our calculations show that almost 1 million people tuned in at different stages over day 1 and day 2. I'm sure that many more of you have tuned in today. We hope you will join us in the future for more BlackRock and Bloomberg Linea produced events. From Mexico City, hasta pronto.
With the help of Fundación Bancolombia and BlackRock, I was able to study user experience. Through this program, I was able to strengthen my soft skills and emotional intelligence, helping me not only to have a new perspective about user experience, but also about myself.